Welcome to Just Minding My Business Media. I am so happy that you stopped by today. We're sitting down with Daniel Sleep, who is a CPA, CTP, and CTS, and the founder of Oakenshield Tax Advisors. Daniel heads a national firm recognized for its proactive, strategy first approach to tax planning, specializing in high income, mission driven business owners and solopreneurs. Daniel moves clients beyond reactive, once a year tax preparation into intentional, forward looking tax decision making. So, welcome, Daniel. I'm so happy that you're here today.
Thanks, Ida. It's good to be here.
Yes, and we just kind of moved through the tax situation, some of us, and it's such a stressful time. And I think it's stressful because we're not prepared. A lot of us are not prepared. So, why do most businesses owners feel blindsided by their tax bill? And how can they change that?
That's a great question. I think it stems from, just the priorities of the business owner, right? You didn't go into business to do your own bookkeeping and have your tax documents always ready. So it tends to go on the back burner for most business owners. It's just I think just how we like to call it the tax guessing cycle, where you start your business or you're running your business, you kind of ignore the tax side of things, or even the bookkeeping side of things, unless you're really honing in on maybe your financials and wanting to see how you're doing, uh, progressing from month to month. But for the most part, you're kind of putting that on the back burner until come tax time, whether you're doing it yourself or you hire a preparer and they're saying, all right, let me get your books. And you're like, oh, yeah, I should probably get that done. Or maybe you're back a few months from having your books fully up to date for the last year. And that's when you get everything, and then your preparers prepping it all. And then they're saying, okay, well, you owe, let's say, $25,000 in taxes. Oh, geez. Is there any way we can lower that? And there may be some back and forth, but for the most part, what's done is done in the past. And a lot of times your cash flow has already been allocated to where you needed it to go. So we have found that we really got to change the mindset from that tax guessing cycle where you kind of feel the burn come tax time, but then you move on and you just uh, you know do it again. So we created what's called the tax precision process, where you really got to shift that change to where it's like, okay, if you want to know ahead of time what taxes are going to look like and how to lower that, how to build wealth and lower taxes, because they work hand in hand. It's actually, I would say, tax planning becomes a wealth building tool. The IRS and Congress specifically create tax law not for the sake of taxation, but for the sake of economic stimulation. So they would want, like, let's say, for example, they're trying to encourage people to invest for their retirement.
Mhm.
So they will give tax incentives for someone. Oh, if you invest $5,000 in your SEP IRA, we will give you a $5,000 deduction because they want to give you that benefit. Now, they're wise in the sense that they know they're going to eventually be able to tax that retirement. And that's why you got to look at things from not just a short-term perspective, but a long-term perspective. But typically, what we do is a seven-step process where we say, okay, let's get your books up to date. And if you need assistance, we can help with that. Then let's account for all sources of income outside of your main income, whether that's a large W-2 or a business. And then you might have a rental, or you might have some investments and dividends. And you want to account for all of that. And then the third step would be tax projections. So essentially creating an annualized projection for the entire year. It's not going to be perfect, but it'll give you an idea of what taxes will look like. And that way you can either say, okay, I'm just fine making quarterly estimates so that I can mitigate or zero out the underpayment penalties and interest that you could be subject to if you owe more than $1,000 to the IRS.
Mhm.
But most people don't want to do that. They want to find ways to strategize and mitigate their taxes, right? Through various strategies, whether they want to purchase a car, do an accountable plan so that they can leverage their home office deductions. Maybe they want to get a health savings account because you get so many wonderful tax benefits that way. There's so much you can do. Maybe you have a kid that you want to hire that does part-time work. It's a tax deduction to you. And if they're under the exemption, it's tax-free to them. So there's a lot of wonderful ways to mitigate your taxes, but those first three steps are so critical. And then step four is optimize for current tax strategies. And that just means let's take advantage of what you already have in place. If you have, an S corp, but maybe you don't have a solo 401k, maybe we should add that on there. Or maybe you're just not maxing those things out. Then the fifth step is actual tax strategy, something that you haven't done before, which I think most people want to jump to that,
Mhm.
but you get ahead of yourself oftentimes where if you don't have the foundation set up, it's almost futile to really jump to strategy, even though that's the most interesting area. And then the sixth step is going to be your implementation, which is actually putting your plan, your tax plan into action. And then finally, the seventh step is prepping for taxes, which should be not a surprise when we file. And we've had wonderful cases this year where we followed those steps and we were pretty close within, I would say, a couple $100 within our projections to tax prep. Ideally, we always have conservative numbers because we want to make sure like the surprise is a good surprise versus a bad one.
Right.
But it does create a little bit more work. And I think our firm, what we try to do is like, how do we systematize this in a way that doesn't require too much work on the business owner side because you're already juggling so many things.
Mhm.
So we tend to try to break out the this precision process through smaller tasks so that they can just focus on a couple at a time. And then the follow up, I think, is one of the most critical components to our client success. If your accountant's not following up with you, and many times it's the business owner following up with the accountant, not the other way around, right?
Mhm.
So that's what I think is a huge differentiator from us. Is any of our clients, they'll tell you that we always follow up. We bug them a lot, and you know, I think for the most part, our clients are appreciative of that. Every now and then they'll tell us to back off, but it's because they're going through something, and so we have to adjust our communication strategy with every other client there. But it's so critical to the success of our clients that you are the best communicator as that accountant, which we are not known for. But that's essentially, how we approach things to help business owners become way more successful when it comes to their taxes, which ultimately affects your wealth, your finances.
Yeah. So nobody likes to owe at the end of the
No.
year. Nobody likes. It's like you go get your taxes done and you see you owe, your whole face change.
Yes.
It's
I hate being that bearer of bad news, right? And that's why I'd rather tell someone 7 months before, hey, you're going to owe. And you either need to be okay with that or you need to work with us proactively to mitigate that. And because again, you don't want that news come tax time because
right.
then it's too late.
Yes, yes. And it's stressful. I mean, you taking the stress out of the tax arena
Hmm.
because what you're doing is you're working with people all year long. pretty much to see, okay, where are we now? You know, what do we need to do? And when the day comes when it's time to file, it's not so overwhelming.
Right. Yeah, that's the goal is that come filing time, if we're filing an extension, it's only because we want to pull your IRS transcripts in May, right? Just to make sure we're not missing anything. But even then, I would say the majority of our clients, if we are filing extension, we are expecting that they are still going to get a refund. We're just
Mhm,
kind of uh, wanting to do that extra procedure. Now, I will say most accountants, they're filing extensions because they don't have all the documents and they're overwhelmed and they don't have enough time. Whereas for us, we prioritize extensions specifically so that we can wait for the IRS to fully process your transcripts.
mhm,
Because unfortunately, they don't have your income and wage transcripts up to date until the end of May of the following year. So that's partially why we do it because we've had clients that forget about 1099s that they got from a vendor. We had one client that very, very well off client. We thought we had everything accounted for, and then he surprised us with $100,000 in interest income.
mm,
And had we pulled his transcript, we would have seen all those 1099s and been able to check that. Another thing is like, if you're getting your health insurance from the marketplace and you don't file for the tax credit form, your return's going to get rejected. So that's another reason why we'll sometimes say, you know what, if you've gotten health insurance from the marketplace and you're not finding your form, I'd rather us file an extension and wait because then I can see it on there, or wait for the client to pinpoint it.
mhm.
But anyways, it's really critical that you become more a part of your taxes throughout the year versus just focusing on it on one time in the year.
Yes, and I know that you work with solopreneurs
hmm
as well as high-end earners. So, what are the differences that you see between the two?
so I would say like a high earner, if let's just say they are getting a W-2, right? Maybe they're not a business owner, but they're considered a high income earner. They may be looking at more investment ways to lower their taxes versus a solopreneur is someone that has a lot of autonomy. They have their own business.
Mhm,
They tend to be more creative. Maybe they're a type of coach or consultant a lot of times. And it really, we're not just looking at investments for them, but we're also looking at how they're structured currently. Are their books up to date? What are their goals overall? I'll give you an example. We had a solopreneur, a wonderful guy named Jeff, who he retired from the state, and so he had a good pension from the state, and he was in his, I would say, late 50s, early 60s, and still very, very active and creative. So he started a side business. It ended up making about 400,000 in revenue, which is pretty amazing. It's a pretty amazing
mhm,
side hustle. And he was netting profit wise about, I would say 150, almost 200,000, give or take. And so he had hired a company called 1-800 Accountants, which advised him, okay, let's make this business an S corp. Let's get you on W-2. Let's do a SEP IRA. None of that stuff was actually bad. It just wasn't the best for his vision and his goals. And so when we really looked at it, we saw, well, here's something interesting. Your wife, she works at Google, and so she's making a lot of money. And so every dollar you make in addition to this business is getting taxed at the highest tax bracket.
mhm,
And what he wanted to do with this business, because it was a product-based business, it just made more sense to not be an S corp. Instead, shift it to being a C corp. And because as a C Corp, you're at a flat tax rate of 21% versus it flowing into your personal business, or sorry, your personal return at that 35 and up
Mm-hmm.
tax rate. So after we did the numbers, we were like, okay, let's revoke that S election and just change this. And I don't want to bore with the technicals, but he ended up exploding in his business to the point where I looked like I was this tax genius. Now, I will say this, the first year he was a C corp, he actually had a little bit of a net loss because he had been doing all of this type of investment in his business and really just trying to find a way to scale.
Mm-hmm.
So I remember even thinking, man, the S corp would have saved him maybe $1,500 in taxes. But the following year, he grew to almost 12 million in revenue, netting well over 4 million. That was insane. And what that ended up happening was we did the C corp, his solo 401k with a profit share, a cash balance plan, and he also did some investments in domestic oil and gas, which really have great tax write-offs for that first year. All of that equated to 1.2 million in taxes saved that year.
Mm.
It
Wow.
was insane. So, and obviously, he didn't even pay me a tenth of that savings. Partially because one, a tax professional can't really charge on a commission basis. I don't think they should ever.
Mm-hmm.
But the other thing too is you don't know where it's going to go. Like had he, maybe done just 700,000 versus multiple millions, he would have saved, but maybe not as much. But the point is the return of investment of hiring a tax planner that actually is customizing the strategies based on your goals
Mm-hmm.
can have such a huge return on investment. And so, he actually made the Fortune 5,000 fastest growing companies list last year as a solopreneur. And I think that's the other thing that's very inspiring to me is that technology, AI, all the things, it's scary, but there is a good side to that, meaning that we can leverage these technologies and marketing to where, a company like that 10 years ago, I don't think could it really exist.
Right.
Whereas now, those are the possibilities. And so I would say it's very inspiring to, work with a solopreneur who has big dreams, but they're also very diligent and disciplined. And I really love working with them because the tax strategies for a solopreneur are are almost endless, whereas somebody that might have a team of 10 or 20 employees
Mm-hmm.
can't quite do the same type of strategies. Like for example, doing a cash balance plan, which is essentially a pension plan for yourself.
Mm-hmm.
You would have to contribute to your employees, and that isn't cost effective for most business owners. So they cannot discriminate and say, okay, well, I'm just going to give myself a pension plan and not my employees. That's illegal. Whereas solopreneur, they're the only employee usually, maybe their spouse or a kid, but for the most part, that's why they're able to leverage those type of retirement strategies, which are huge tax savings. You can save anywhere from 30 to close to 100 grand depending on what how much you're contributing to those.
Mm-hmm.
And that's why I really love working with solopreneurs because they have so much more flexibility, autonomy, and the strategies tend to not be restricted based on, what they should provide to their employees. And that's not to say I don't believe in employees. It's just that it's been my experience that the solopreneur just has a little less to think about when it comes to what strategies they want to implement, right? And
Mm-hmm.
so it's a very exciting. And I don't mean to ramble on. I love working with solopreneurs.
No, that's fine. That's fine because I mean, I've just our audience by you elaborating so deeply, they can vision.
Hmm.
exactly what you're talking about. So if companies want to work with you, how do they connect with you, Daniel?
Yeah, so it's as easy as, going on our website, oakenshieldtax.com. They can you send me an email at daniel@oakenshieldtax.com. We have, obviously, I'm on LinkedIn at, I think it's linkedin.com/Daniel Sleep CPA. Same thing with Facebook. I have a Facebook page. I'm trying to be on everything, TikTok, YouTube. Uh, Very easily they could Google me, Daniel Sleep CPA, and they would find those resources. But if they typically what we do is we'll do a quick discovery call, but then we tend to do what's called an upfront assessment, right? And I would say recently we've really focused on solopreneurs that are reaching that age of wanting to accelerate their retirement, and not just accelerate their retirement, but focus on tax-free retirement.
Mm-hmm.
That has been a huge focus of ours for the last few years, where we've had a lot of solopreneurs that put a lot in their 401ks or their SEP IRAs, but they know eventually when they take it out, it's going to be taxed. So, how do we convert some of that to Roth without yanking up your tax bill? And so, there's various strategies there that we help with. So, I would say if a solopreneur is either looking to defer lower taxes significantly, or they're wanting to create investment to lower taxes, or the third is Roth conversion strategies that obviously don't yank up your tax bill. We definitely be definitely be worth a conversation.
Yes, yes, indeed. It's because taxes and strategies, that's like not many people's lane.
Right.
You a special person, Daniel. You are indeed a special person. So let me ask you about what decisions do you see high income entrepreneurs wish they had made earlier on in their journey?
I have noticed that the solopreneurs, especially those in their 50s and up, are really focused on their retirements being put in the right accounts. So I'll give you an example. Um, Years ago, I had a very, very savvy investor hire me to do some tax planning. And typically, when, years ago, when we do tax planning, we're just focusing on how to lower taxes. But what this guy had done is he had worked for tech companies as just an employee, invested, built his retirement, had a very large retirement. Well, now he had shifted and pivoted into actively working in real estate, which definitely had its benefits. And so he wasn't really owing any taxes. And I remember scratching my head thinking, so why did you hire me? And it was essentially to help him do a Roth conversion without having to pay the tax.
Mm,
So let's say, for example, you have $1 million in your 401k. You want to get that out into a Roth because when you're 73 or older, the Congress says whether you need that money or not, we are going to force you to take what's called a required minimum distribution
mm,
so we can tax it. And so that is what is looming on a lot of these solopreneurs that are in their older years where they're knowing that that's coming. And
mhm,
so, how do we mitigate that in the future? That is something I've seen whenever I mention Roth conversions. My solopreneurs that are in their 50s or above perk up. They're like, tell me more. Because I know I need to put stuff in Roth, but a lot of times they're making so much money that they can't put any money into a Roth account because there's income limitations
mhm,
unless they do a backdoor Roth or a mega backdoor Roth through their 401k, and that can be hard to do because you still have to pay the tax up front. So a lot of times it's better to defer and just wait for the opportune time to do a conversion. So back to this guy, Jocelyn. He had some losses and he was applying for Social Security. And he was like, I want to see if I can convert more than 100,000 this year in Roth. And so we ended up realizing that he could accelerate the depreciation on his real estate to
Mm,
have more losses. And I remember telling him, you can convert 400,000 without paying a one red cent in taxes, which normally with any Roth conversion, the IRS says, yes, go ahead, because they think we're going to tax you on that. And if you convert too much, we're actually going to be able to tax you more than usual.
mhm,
But they don't really account for those people that know how to offset with business losses, investment write-offs. And in his case, he had active real estate losses. And I remember seeing it. He was too afraid to do 400,000. He was like, that's just way too much. What if the calculation's wrong? Well, it wasn't. But what he did instead, he said, I'll split the difference. I'm going to do 200,000. And so he was able to move 200,000 from tax deferred to Roth and have to report that 200,000 on your taxes, which the IRS is like, all right, now we get to tax you. But those losses completely absorbed the income.
mhm.
So his tax bill for state and federal was zero.
Wow.
That is seeing that, actually like tangibly seeing that, because we hear a lot about strategies and like, oh, you should, rent your house to yourself and it'll be income tax free, or and people think, well, that sounds cool, but how do you do that?
Yes.
Or how do you convert from like how do I just call up my broker and say, hey, I want to convert some money from my 401k to Roth? The short answer is yes, but how do you know that it's not going to be taxed? Or how do you know how to mitigate the taxes? That's why we do tax return simulations, where that's one of the things with Jocelyn. I was able to confidently show him, look, based on current tax law, you will be okay. And I remember showing this to some colleagues of mine. I was like, look at this. He converted 200 grand to Roth tax free. And a lot of my colleagues were like, why didn't he convert more? And the short answer is he was afraid. This was
Mhm.
new. And
Yes.
and you know, I expect most entrepreneurs, solopreneurs to be a little concerned because you don't want to do something wrong. So you want to make sure you're working with someone that understands the mechanics of how to properly report these things, how to properly do them, that can kind of hold your hand in the process. But what's wonderful is, if in case people don't realize why Roth is so incredible, is that if I give you two people living off $180,000 in income, one is a single taxpayer, let's call him Bob, and let's call Jill the second taxpayer. They're both making the same income, but Bob pays $31,000 in taxes and Jill pays zero. How is that possible? It's because their breakdown of income is this: 150,000 from a 401k, 35,000 from Social Security, and then let's say $1,000 from interest income. Because it's tax deferred, it's now taxable. So Bob has to pay $31,000 in taxes as a single taxpayer. But Jill, because her 150 is coming from the Roth, the IRS says it's from a Roth. You've either already paid the tax or you contributed this post tax in some way or form. So it is completely tax free. And so, I mean, that $31,000 in additional income, you could leave it in there, and over a span of 20 years at a rate of even 5%, you have an additional $1 million in your portfolio. That's
Mm,
a lot of vacation money,
yes.
right? It's a lot of cruises.
Yes.
And that's, I think, what a lot of my clients that, are knowing that that horizon's coming, they know the importance of that. And it's an area that I've found very, very fascinating. So I would say those that are in that horizon that want to find ways to mitigate, and not just mitigate taxes, but also create it in a tax-free environment, definitely worth a conversation.
Yes. Now with the Roth, um, when should you start one? And if you was a late bloomer, so to speak,
Hmm. Yeah.
what's the latest you can start it?
What's wonderful is you can convert to Roth at any age as long as you have what's called earned income. So, as long as your income isn't being derived from passive investments, you can contribute to the Roth. Now, if you make too much income, and that can happen where you just need to look up the limitations. So, I can't remember off the top of my head, but let's just say it's 200,000 for a single taxpayer. It's probably lower than that, but if you're making too much, you can't contribute to a Roth IRA unless you do what's called a backdoor Roth. So there's still ways around it. It's just that you kind of have to follow a few added steps. So I would even say to those that think they make too much, don't be deterred. There's plenty of ways you can still contribute to a Roth. So if your income is low enough, just contribute it, just start contributing because that will continue to grow tax free. It'll compound. What's really cool too is I actually did a little simulation yesterday where we showed a solopreneur hired their 10-year-old just one time. They hired their 10-year-old and they paid them $7,000 net payroll. So and they took that 7,000 and they opened a custodial Roth IRA and then just invested it in the S&P 500. And let's just say they never hire their kid again. They only did it once. They were not good. They were 10 years old. They didn't do a good job. And but they just leave that money in there. And the last 40 years, the our return on investment of the S&P 500 has been 11%. So if that 7,000 is invested in S&P and no other contributions are made, when that child is 67, they will have 3.5 million in
Wow.
their Roth account. And that, of course, time is the other element there.
Yes.
Um, but what's amazing is that, that person, that situation, you can have somebody never contribute to retirement and yet be completely fine. Now, that's not going to be everybody's situation, but I think ultimately you want to prioritize Roth just because it gives you more flexibility. When I would say when I was working in financial planning, RMDs, required minimum distributions, was a very big headache for a lot of our clients. And some of them, what they would do is they would take their RMD, their distribution, and they would pay the tax. And if they didn't need any additional money from that distribution, they would just simply put it in a Roth account, knowing that that will grow tax free. So sometimes that's something that people will do too, because it is earned income because it's being taxed, right? So
Mhm.
that's the other thing you can do there. But I would say, hell or high water, find opportunities and ways to max out your Roth on an annual basis. There's a lot of ways to do it. And as of yet, the Roth, here's the other thing too, is the Roth is relatively young. It wasn't actually put into law until 1998. So that's why a lot of our uh, older population don't have their money in Roth. And even back in 1998, you could only put $1,000 in.
Mhm.
So not a lot. Whereas now it's 7,500, and it keeps going up, right? And as law stands, it is tax free. So I don't know if it'll ever change. Hopefully it doesn't, but um, it is the most powerful instrument other than, actively being involved in real estate. And I would even say real estate has its disadvantages and complications that otherwise putting your money in a Roth IRA just being invested and earning that income is a lot simpler. It's a lot easier. So, I could talk about this all day, but tax strategy, I think at the end of the day should be focused on how to mitigate tax and build your wealth in a tax-free environment.
Yes, and from what I'm hearing, there's a lot of creativity
Oh,
involved.
yes.
It's
Yes. A
almost
lot.
like being an artist of money and how to mitigate and how to I'm just loving the way that you express it. It feels artsy to me.
And I will say, it does require a level of creativity. Only in the sense almost like a chess game, right? There's rules to playing chess and there's specific things you can do and you can't do, right? Like your pawn can't act like a queen and the bishop can't act like a knight. But if you follow those rules, and many times if somebody comes to us with an idea, we'll go to court cases with the IRS to see are there any concerns there. Like there have been very well known tax strategists that will share very inaccurate information. So you just have to be very careful. Like, for example, um, I've actually know of two very well known strategists that are adamant you can deduct your haircuts as a business deduction because you have to look presentable. That argument is fine. It does make sense. And they look at it and they say the IRS says whatever is ordinary and necessary. Well, it's necessary for me to look presentable. However, they're not digging deep enough. If you go to IRS court cases, there's at least 4 or 5 court cases where they show this person, if it benefits you personally, there's a substance test, right? So you never want to think, oh, I'm going to be able to explain myself away, because that's what happened to these individuals is they said, well, it's ordinary and necessary, and the IRS would say, no, it's not. It doesn't have substance to it, and
Mhm.
then they would say, fine, I'm taking you to court, and that's when the IRS reveals exactly how and why this didn't pass the sniff test, right? And so we'll definitely be creative, but we'll never mislead you into an area that we know is not going to pass an audit.
Yeah.
So that's the balance there is can we be creative? Can we find court proven strategies? And can we do it in a way that even if you were to get audited, it would have a zero result because we're following everything not just by the court, not just by, sorry, section code, but by court cases.
Hmm.
Because that's the ultimate pillars and standard is the court case. You can't
Yeah.
really argue a court case um, again, in an audit, whereas in misinterpretation of the tax code, the IRS agent can simply say, "Yeah, you misinterpreted that code, and we're disallowing those deductions."
Yes,
So,
yes. I can see how that'll be hand in hand for
yeah,
sure. Yeah, that way, if they say something about it, well, this court case right here,
exactly,
it was fine.
exactly. And I do think a lot of people worry and get, they shrivel up and they're like, I'm getting audited," and uh, you know, if you got good documents and you are able to supply those, I would say, I think there was a statistic done that 50% of the audits resulted in no change.
Mhm.
So, which the IRS, it's actually a waste of money for them to to do that, to hire, assign an agent there to review their documents and say, oh shoot, well they did everything right. Um, it resulted in no change. So, if you're following everything closely and you're not pushing the envelope, and you're implementing strategy that's legal and permitted, you should sleep very well at night.
Yes, and even though when you get that audit, it's like this feeling you get, but
Yeah.
I'm one of those people, if I don't have documentation for it, I'm not even going to put it in there. for that very reason,
Right.
just in case.
I wish that was how everybody approached things, but we find that a lot where, someone will say, "Oh, well, I don't have documents for it," and I have to tell them, "Okay, well, just be aware if you don't have support, it's not
Yeah,
going to look good."
yeah, and
So,
it's putting yourself out there for no reason.
right, you don't want that karma.
No, 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 exactly. It's already stressful enough with taxes. You know what
Yeah,
I'm saying? Just the way you feel about it. And then you bring in all the stuff to the table that ain't right. No, and no.
yes,
Wow,
exactly.
Daniel, this has been awesome. I love talking to you, and I've learned quite a bit. And the way you explain it, it makes it so easy to understand. So
Thank
much
you. I
easier to
appreciate that.
understand. So, how do businesses connect with you again?
I think the best way is via email at daniel@oakenshieldtax.com. Obviously, we have our main website, oakenshieldtax.com. I think if anybody just Googles me, Daniel Sleep, just like you sleep at night, CPA, they'll find all those resources. And I'm on YouTube, Instagram, Facebook, LinkedIn. They can get in touch with me, and at minimum, we typically will do a 20-minute discovery call to at least point you in the right direction. And yeah, that's again, if you're looking to lower taxes, but also focus on, I would say, our older solopreneurs that want to focus on tax-free income for the rest of their life, that we would definitely be a good resource for them.
Yes, exactly. And we have all of your handles, your social media handles and everything, and we will definitely include it in this in the show notes. So I
Wonderful.
really, really appreciate this, Daniel. This has been amazing. And I know that my audience is definitely going to eat this up because this was good stuff.
Yeah,
This is really good. And I could feel your passion about it. And that's what I like. When people are truly into what they're doing and you can feel it.
I appreciate that. At the end of the day, it's like it's one of the tools that will allow you to live your best life, right? And in a way that will allow you to pursue the things you want to pursue. So that's our goal, is that if we can focus on how to create tax-free wealth, then we've done our job. And people can live more abundantly, they can save more, they can give more,
Mm,
and they can just do more with
yeah.
their lives.
And that's what it's all about, helping people live their best life. I have to
Wonderful.
agree with that. So
Yeah.
thank you so much, Daniel. And audience, thank you so much as well. We appreciate you.